In the early 1990s, Orange County, California was one of the wealthiest jurisdictions in the United States, home to roughly 2.5 million people and a tax base anchored by aerospace, real estate, and commerce. Managing the county's investment pool was Robert Citron, a Democrat who had served as county treasurer since 1970 and who won re-election year after year by consistently delivering returns that exceeded what rival county funds earned. By the early 1990s, roughly 200 local agencies, school districts, and cities had entrusted their operating cash to Citron's pool, which held approximately $7.5 billion in contributed assets. His reputation was essentially unassailable. In 1994, he defeated a challenger who explicitly warned that his investment strategy was dangerously risky. Most voters sided with the track record. Citron's outperformance was not magic. He was running a carry trade using a technique called a reverse repurchase agreement or reverse repo. In a reverse repo, Citron would post the pool's existing securities as collateral to borrow cash from Wall Street dealers, typically overnight or for short terms. He would then use that borrowed cash to buy more securities. By stacking these borrowings repeatedly, he effectively multiplied the pool's firepower. According to the analysis by finance professor Philippe Drouillon in his contemporaneous study of the collapse, the pool's $7.5 billion in contributed assets controlled a total market exposure of approximately $20.5 billion, implying a leverage ratio of roughly 2.7 to 1. This was not prohibited for a county treasurer under California law at the time, but it meant that any loss on the underlying securities was also amplified by that same multiple. Citron did not simply buy treasury bills with his borrowed billions. A substantial portion of the portfolio went into structured notes called inverse floaters. A standard floating rate note pays a higher coupon as interest rates rise. An inverse floater does the opposite. Its coupon rises when interest rates fall and drops when rates rise. These instruments were sold by Wall Street dealers, with Merrill Lynch serving as the pool's primary broker. Inverse floaters allowed Citron to earn an above-market yield as long as interest rates stayed low or continued to decline, which is exactly what had happened through 1991 to 1993, as the Federal Reserve cut the federal funds rate from about 6.5% down to 3%. For Citron's strategy, the early 1990s were a nearly perfect environment. The returns came in, no one in the county's oversight chain examined the mechanics underneath, and the pool grew. From 1991 through 1993, Citron's strategy generated returns that routinely exceeded state and competing county pools by 1 to 2 percentage points annually. On a multi-billion-dollar pool, that gap translated to tens of millions of dollars in extra income for participating agencies, which let them fund services, avoid tax increases, and lower their own borrowing costs. This success created a political feedback loop. The County Board of Supervisors received glowing performance summaries, local agencies added more cash to the pool, and Citron became something of a local legend. A later congressional investigation noted that Citron had relied in part on investment newsletters and, according to his own later statements, the views of an advisor whose forecasting methods included astrology. The larger point is structural. The strategy had no independent risk audit, no real-time leverage disclosure to the county board or participating agencies, and no stop-loss mechanism if rates moved against it. On February 4, 1994, Federal Reserve Chairman Alan Greenspan announced the first increase in the federal funds rate in 5 years, raising it by 25 basis points from 3% to 3.25%. The move surprised markets that had priced in a continuation of low rates. What followed was an aggressive tightening cycle. The Fed raised rates 5 more times through the rest of 1994, ending the year with the federal funds rate at 5.5%. A gain of 250 basis points in 10 months, according to the Federal Reserve's published records of open market operations. For Citron's portfolio, each hike was a simultaneous double blow. The inverse floaters lost market value and coupon income as rates rose. At the same time, the short-term repo borrowings that financed the portfolio repriced upward constantly, raising the pool's cost of carry. The fund was caught in a textbook duration mismatch: long duration, rate-sensitive assets funded by short-term floating rate liabilities. Through the spring and summer of 1994, Citron continued to roll his repo borrowings and hold his positions, expecting rates to reverse. They did not. By autumn, some Wall Street dealers grew nervous about the collateral backing their loans to the pool. In November 1994, Citron abruptly resigned, citing health reasons. A review by the county auditor and subsequently by outside consultants confirmed a paper loss of approximately $1.7 billion on the pool's reported asset base of about $7.5 billion. A loss of roughly 22% of contributed capital. Because the pool held the operating cash of cities, school districts, and special districts that depended on it for payroll and services, the damage was immediate. Local governments suddenly could not access funds they had counted on being there. On December 6, 1994, Orange County filed for protection under Chapter 9 of the United States Bankruptcy Code, which governs municipal insolvencies. It was at that point the largest municipal bankruptcy in American history. The county faced a stark arithmetic. It could attempt to liquidate the pool immediately and lock in the full loss, or it could hold the positions and hope for a rate reversal. Under pressure from creditors, most of the portfolio was eventually liquidated. The county's operating budget was gutted. Roughly 300 county employees lost their jobs in the months that followed, and a range of public services were reduced or eliminated. A proposed half-cent sales tax increase to cover the losses was put to voters in June 1995 and rejected, leaving the county to rely on asset sales, fee increases, litigation recoveries, and renegotiated creditor terms to work its way out. In April 1995, Robert Citron pleaded guilty to 6 felony counts related to securities violations and misuse of public funds. He was sentenced to 1 year in county jail, which he served through a work release arrangement and ordered to pay a fine of $100,000. Merrill Lynch, which had been the pool's primary broker and had earned substantial fees selling the inverse floaters and arranging the repo financing, faced extensive legal and regulatory scrutiny. Internal Merrill Lynch documents produced in subsequent litigation suggested that some within the firm had raised questions about the concentration and leverage of the county's positions. Merrill Lynch contested those characterizations. The firm settled a lawsuit brought by Orange County in 1998 for approximately $400 million without admitting wrongdoing. Several other Wall Street firms reached smaller separate settlements. Orange County also sued its outside auditors and bond counsel. The Orange County collapse exposed a specific and consequential gap in the oversight architecture of American public finance. At the time, county treasurers in California operated with broad statutory discretion over investment strategy and minimal real-time disclosure requirements. The county's Board of Supervisors received periodic performance summaries, but not the detailed leverage and duration data that would have revealed the risk. The pool's participants, including school districts and cities, had contractual rights to withdraw funds but lacked the information needed to know they were in danger. The California legislature responded by passing reforms that tightened investment restrictions and disclosure requirements for public investment pools, including limits on the use of derivatives and leverage structures. Other states reviewed and in many cases updated their own public fund statutes in the aftermath. Orange County's collapse did not happen in isolation. The year 1994 inflicted losses across the entire fixed income market as the unexpected tightening cycle repriced bonds that had been purchased at low rate assumptions. Several other institutional investors suffered badly in the same environment. The hedge fund Asken Capital Management, which had been heavily positioned in leveraged mortgage-backed securities, collapsed in the spring of 1994, and its liquidation contributed to volatility in the structured note markets where Citron was also active. The inverse floater market itself, which had grown rapidly through the early 1990s as Wall Street dealers created tailored structured notes for yield-hungry investors, contracted sharply after the Orange County episode. The crisis contributed to a sustained regulatory and congressional examination of how Wall Street sold complex instruments to public sector clients. Orange County exited Chapter 9 bankruptcy in June 1996, approximately 18 months after filing. The resolution came through a combination of litigation settlements with Wall Street firms, the sale of county assets, renegotiated terms with creditors, and operating budget cuts that the county implemented without the voter-approved tax increase. Pool participants recovered varying amounts. Some received most of their principal back over time through the settlement and liquidation process. Others accepted negotiated amounts that fell short of their original deposits. The episode did not trigger a contagion of other municipal failures, partly because the structure Citron had built was unusual, and partly because the federal government did not bail out the county. The absence of any federal rescue was deliberate and was widely noted at the time as a signal that municipal creditors bore real credit risk. The Orange County story is not primarily a story about one reckless public official. It is a case study in what happens when a yield gap that looks like skill is actually the product of hidden leverage and a one-directional rate bet. That pattern has recurred in different forms across different eras, when any pool, fund, or institution consistently earns more than its peers without a clear, transparent explanation of how. That extra return is almost always sourced from somewhere, usually additional risk, additional duration, or additional leverage, and often some combination of all three. The specific instruments change across decades, but the mechanics stay the same. Borrow short, buy long, and hope rates cooperate. For anyone evaluating a fund, a bank, or even a municipality, the two most important questions are how the return is being generated and what happens if the rate or credit environment reverses. Orange County paid $1.7 billion to demonstrate why those questions matter. The rules now in place for public investment pools in California and many other states exist because someone had to pay that tuition first.